Hello, accounting scholars. I'm Dr. Baldwin, and this is the example in Chapter 3. We're going to work this example about Brownell Company. If you haven't worked this one already, this is Demo 3B. Make sure you've downloaded the PDF, printed it, worked it, and then watch the video. What do we have here? We have a whole bunch of accounts. So the following are all the accounts of Brownell Corporation that have a balance at their fiscal year end, May 31, 2013. Assume all the accounts have normal balances and use this information to answer the questions below. And when you get a problem to work like this, you need to look at the questions but don't dive right into answer them. What kind of questions are you being asked? Well, you're being asked, number one, what is the net income? Number two, what is the retained earnings? Those are obviously related to one another. Number three, what is the total assets? Number four, what are the liabilities? So that's part of the accounting equation or part of the balance sheet. And then a little bit of financial analysis. Number five, what's the company's current ratio? And at number six, how does that compare to an industry average? So a whole bunch of things going on. The first thing you need to do is figure out what are these accounts. So let's think about all of these accounts. We're going to have to figure out which ones are the assets, which ones are the liabilities, which ones are the revenues, etc., so that we can actually answer the questions. So the sensible first place to start is to prepare a trial balance. You can make sure the numbers make sense, and you can make sure you have identified everything you need to identify. So I've blown up the numbers a little bigger on the screen here. I'm going to give myself some room to work. First of all, I'm going to make a trial balance, so I'm going to give it a heading. So this is the Brownell Company. And this is their adjusted trial balance. And it's on the date, the fiscal year end, if you like, May 31, and I believe the year's 13. I'm going to make a trial balance here. What do we have in the trial balance? We have a list of all the accounts in a sensible order, and we have their balance, whether it's a debit or credit. So we're going to have two columns of numbers here. Some of them are going to be debit balances, and some of them are going to be credit balances. The first thing I would do, I think, is identify which of these are assets and so forth. So let's just look at the list. Accounts payable, what is that? That's a liability. Anything with payable in it is going to be a liability. So you might want to just go down the list here and see if there are any more that have the word payable in them. Do you see any of those? I see one right here, notes payable. So I'm going to put an L by that. What else do we have? Well, let's go back to the top. Accounts receivable, that's an asset. It's a current asset, in fact. What about accumulated depreciation? What is that? Well, that's a really weird account. That's a contra asset. We have to subtract it from the assets. Its normal balance is a credit, not a debit. All the assets are debits. This is a contra asset. Advertising expense, I'm going to put an X for expense. Cash, well, that's clearly an asset. Common stock, that's an equity account. Depreciation expense, you see I'm using X for expense, so don't get it confused with equity. Dividends, that's an equity account. Equipment, that's an asset. Office supplies, another asset. Rent expense, that's an expense. Retained earnings, that's obviously something that goes on the equity section of the balance sheet. Service revenue, hey, finally a revenue, that's handy. And then another expense. So I've identified for myself what these accounts are. So now I'm going to go back and keep working on my trial balance. The order we usually find them in the trial balance, actually it's by account number, but we haven't even really talked about account numbers here. So let's talk about what that logic is. That logic is you have all the assets first in order of liquidity, and if you have any contra assets, they go alongside whatever they're contra to. Then we have the liabilities, and then we have the equities. So we basically have balance sheet order, and then after that, we're going to have what's left. And what's left is dividends, which is an equity account. Obviously, that affects retained earnings. Then we'll have everything that goes into income. We'll have all of our revenues and all of our expenses. Let's start out. The first thing is always going to be cash, so that one's not too hard to think through. And the balance of cash, let's see where they are. I'm going to tick them off as I go, is $25,000. And it's an asset, so we know it's a debit balance. I didn't write debit above for my column, so I put a little D there and a little C here. The abbreviations are actually DR and CR, which makes no sense because debit doesn't have an R in it. But supposedly it comes from the Latin or something like that. So we've got cash. The next one is usually accounts receivable. We can see that one here, so I'm going to abbreviate AR, and it's got a balance of $40,000. Let's see, what else do we have that looks like a really current asset? How about office supplies? And its balance is $3,000. Find some more assets. Look for the A's. Oh, we have equipment. We haven't put that one in yet. Let's put equipment in. And equipment's balance is $50,000. Do you see any more assets there? I don't see any more assets, but we still need to deal with this one. This is that contra asset. So let's go ahead and write it in. Accumulated depreciation, we'll assume it's associated with the equipment since that's the only long-term asset we have. Remember, accumulated depreciation is contra asset, so it has a credit balance. So I'm going to write it over in the credit column. You need to know what the normal balances are for each kind of account. So we have any more assets here? Asset. I'm just looking down my list. I think I've got them all. Now let's look for the liabilities. Well, the next one would be accounts payable. Accounts payable is right up here, so I'm going to mark it off, $15,000. It's liability, so it normally has a credit balance. And we had another one somewhere. Oh, here we go. Notes payable, so we're going to write that one in. Notes payable. And that one also was $15,000. And then we have, that's it for liability. So we'll go to our first equity account, which is common stock. And it normally has a credit balance, of course, because it's an equity account. We're going to write it in, $25,000. Check it off. All right. What else do we need? We need our retained earnings. I'm going to abbreviate here. Retained earnings. Notice the date here. It's at the beginning of the fiscal year because we haven't closed out our net income and our dividends to that account yet because we're looking at an adjusted trial balance. So I'm just put that here as a reminder. And it's $50,000. What else do we need? Everything that's left is something that eventually ends up in equity. All right, something that affects retained earnings. The first thing is dividends. Remember, dividends have no effect on net income, but they do have effect on retained earnings. Dividends, where are our dividends? $10,000. Think about this. What do dividends do to retained earnings? What do they do to equity? They decrease equity. Well, equity normally has a credit balance, so to decrease it, we're going to have to debit it. So the normal balance of dividends is a debit balance. So it looks like everything we have left now is either a revenue or an expense. So let's get our revenue. We've only got one revenue account here, service revenue. And it is $70,000. Revenue increases equity, so it normally has a credit balance. And then we've got some expenses. We've got advertising expense. Expenses decrease equity, they decrease net income, they decrease retained earnings, therefore their normal balance is going to be a debit. This, let's see, where's it at? This one is $4,000. Mark it off. Then we have depreciation expense. I'm just going down and ticking them off in the order they're in. Depreciation expense is $2,000. What do we have left here? Rent expense. $6,000 and wages expense. Just kind of squeeze it in. $40,000. Now let's add up our two columns. So we've got in the debit column, we've got $25,000, $40,000, $3,000, $50,000, $10,000, $4,000, $2,000, $6,000, and $40,000. If you add all of those up, hopefully, we'll just call it total for now, you get $180,000. $180,000. Now, hopefully, if we add up the other side, we'll get something similar. All right, I'm scrolling up, but all of our credits are still showing here. So on the credit side, we have $5,000, $15,000, $15,000, $25,000, $50,000, and $70,000, and that should add up to $180,000 as well. Remember, our debits and credits have to be equal. So you might be thinking, well, why are we going so much trouble to add it all up? Well, if we don't do this, chances are we'll make a simple mistake and just trying to do them in our head or do them on a scratch corner. So we want to be able to check all of that. And we know here, you can see we've used every account. Another way to check that is to see how many accounts you have listed. Count them. Literally 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Are there 15 over here? And if you count them, you will find that there are. Why would you double check that? Because you're trying to keep yourself from making a mistake. So let's scroll back up and look at the first question. What is net income for the fiscal year? Well, what's net income going to be? Net income is going to be the difference between the revenues and the expenses. It's all right there. So the revenues of $70,000, in fact, I might just copy that piece out just to make my life easier. Copy. Gonna put it right here. So here's my calculation of net income. Give it a heading, net income. We have our service revenue. We're going to subtract all of these expenses. So we've got 40,000 plus 6 plus 4 is 50 plus 2 is 52,000. So we're going to subtract 52,000 from 70,000. That's going to give us our net income because it's going to be a positive number, and it's going to be 18,000. Now, it wouldn't be net income if it were negative. If it were negative, it would be net loss. So I'm just going to highlight that. There's my answer to part number 1. I'll just mark it here on my paper. Next question is, what is the amount of retained earnings on May 31, 2013? Well, just as this here was basically an income statement. In fact, we could, name the company Brownell Company, call it an income statement. And do it, for the year ended, if it was May 31, 13. And lo and behold, what do we have there? We have an income statement, all right? Well, what are they asking us for now? They're asking us for the retained earnings. So we could actually write out, statement of retained earnings. For Brownell Company, give it a heading. Pretend this is another sheet of paper. For the year ended 5/31/13. You don't have to do this, but if you were asked to do this, you'd have everything you need, right? We could start with our retained earnings at the beginning of the year. In this case, it was not January 1, it was June 1 of 2012. And we know those. They're given up here on our list. They're given right here. We've already used that number, 50,000. What else affects retained earnings? Well, net income that we just figured out here increases it. So I'm just going to take this number and add it. We're going to add net income, 18,000. That's going to get us to 68,000. But that's really just an intermediate number because we have to subtract out our dividends. And our dividends, which were up here, were 10,000. So our new balance in retained earnings at the end of the year, which in this case was 5/31/13, you could be given a problem, didn't actually have dates, just had beginning of year and end of year. You could just write BOY and EOY for that. That would be fine. Our retained earnings is 58,000 at the end of the year. All right. What's number 3? Number 3 asks us, what is the amount of total assets at the end of the year? Well, all we have to do here is add up the assets. And the trick, so to speak, it's not really a trick, but the thing you need to know is this accumulated depreciation. You have to take that into account. So I'm just going to copy that section just to make it easier to write here. So here's my list of assets, and I picked up a few other scribblings, so get rid of those. So So we're going for all the assets. And you can see we can add them all up here. We can get a subtotal, I'll give it a heading. Not really doing a balance sheet here, we're just doing the assets. So 50,000 plus 40,000 is 90, plus 25 is 115, plus 3 is 118, I believe. So we have 118,000. And then we're going to subtract that accumulated depreciation. And that's going to give us our total assets of 113,000. Remember, accumulated depreciation is a contra asset. You have to subtract it. It's got a credit balance. So now we've done, didn't even label this one. This was part 2 up here. This one's part 3. Now, what was question 4? Question 4 is what was the amount of liabilities? Well, that one's pretty easy. If we go back up here and look at our list we made, we have exactly 2 liabilities. So the math here is not going to be particularly exciting. Easy math. Let's go over here. All we do is we add up those 2 liabilities, which is not rocket science this time. It's very easy. And we get 30,000. So these are our liabilities. Total liabilities. So 30,000. And I'm going to label it so you can find it here in the midst of my chicken scratch. And we have another question here. What is the company's current ratio? And then it asks us, compare it to the industry average of 2.3. So let's figure out the current ratio. The current ratio, we take all of the current assets, those are the short-term assets, and we divide that total by all of the current liabilities. We've got these assets here. Equipment is not going to be counted because it's long-term. And we have all of these liabilities, which presumably are short-term. If we had something long-term, it would probably be called long-term notes payable or some other more descriptive term like mortgage payable, with a much more long-term view. So we're going to have current assets divided by current liabilities. All right? So current assets are these right here, 25 plus 40, that's 65, plus 3 is 68,000. And we're going to divide by our current liabilities, which is, I don't even have to do math for that, 30,000. 68 divided by 30 is going to give us 2.27 for our current ratio. Now, this is number 5, just highlighting it for you. We were asked in number 6, how does the company's current ratio compare to the industry average of 2.3? Well, if the industry average is 2.3, then the company's just a hair below that. Not a huge amount, probably not significantly different, but just a hair below the industry average. It's right around the industry average. So that's the solution for the Brownell Company. But what did I do? I created a trial balance. Did it ask me to create a trial balance? Nope, didn't. But that was the sensible thing to do. If you're in a real big hurry on a test, you might say, well, I'll just do this step. I'll highlight what's what and I'll do the math like we did over here, sort of off to the left. Well, that's fine, but there's no way to check to see if you left anything out. If you do the trial balance, you have some assurance that you've got it all in there and that both the columns add up. If they don't, if the debits and credits don't equal, then you go back and figure out where your mistake is. And you can see that I basically made an income statement here. It didn't ask me to do that, but it asked me to calculate net income so I can make an income statement. And then here it asked me to calculate the ending balance at the end of the year of retained earnings. So I basically made a statement of retained earnings. Okay? Yeah, it didn't ask me to do that, but all I got to do is add a heading, and I've got one. Okay? Didn't make a balance sheet, but it did ask me, hey, what were the assets? And that's what we did here. And what were the liabilities? And then we used just the current assets and just the current liabilities up here in our math. Okay? To figure out our current ratio. So our current ratio is 2.27. Okay, that's the kind of question you could be asked on the test. That's some basic manipulation of basic financial accounting numbers.